Hi everybody, this is Rootvij, here with Harish, Mahesh, and Raghav, and welcome to the 7th episode of the podcast, which will consist of market news, information on how IPOs work, and underwriting as well, and due diligence on Factset, or FDS, which is a ticker.
So we'll start today with the market news that happened since our last podcast release. The latest one, of course, is the TikTok acquisition by Oracle Walmart, which looks pretty promising. Previously, TikTok was going to be banned, as announced by the POTUS, but that was supposed to happen today on September 20th, which was cancelled because, like I said, the deal does look promising, and it could possibly go through. What do you guys think?
Yeah, I think Trump has already approved the deal, and it seems like it's, in full swing now. But personally, I don't think the deal itself is very value creating because Oracle they don't have access to the TikTok algorithm or anything. They're just hosting TikTok on their servers, which does make the data secure, I guess. But at the same time, I don't like the fact that they're not getting really any information from it. It's more like they're just, getting a smaller revenue stream now. And I guess Oracle, they probably don't know how to run a social media company either, and neither does Walmart, obviously. So, yeah, I don't know, Mahesh. What do you think?
I feel like it's just a very strange kind of acquisition to make. Oracle and Walmart, two companies that are, I guess Oracle is pretty solidified in the database space, pretty much an enterprise company at this point. I just don't see how it could benefit from this acquisition, them specifically, right? And
yeah, I think the main purpose was this is that we had a lot of security concerns with the CCP. I won't go into any of the validity of that.
Yeah.
But even with a deal like this, I would have assumed that it would have gone towards a company that focuses more on social media. Rather than Oracle, which doesn't really, it's kind of out of their industry, right?
Yeah. Company statements, everything, pretty much everything goes through Oracle's SQL servers at this point. Like all federal databases, military databases, they're all hosted through Oracle's SQL servers. So I guess I'm not going to go into the ethics of it, but sure. We could have an increase in data security. But the fact that they're not having access to the actual core algorithm in TikTok is just not value creating, like you said.
Yeah. And also, I think it could work, like the positive situation, the glass half full perspective, is that Larry Ellison, he's a very eccentric CEO, right? So I feel like he can maybe, make it work and somehow it would be value creating for Oracle. But yeah, I think leadership would play a big role for that. I'm not sure how Walmart would do and how their leadership is in that sense. But if they can make it work somehow with the retail space and integrate it just, to actually create something, then that would be cool. But I feel like other than that, this is more of a publicity stunt.
Next, we have the NVIDIA acquisition of ARM Holdings, which did go through as we expected on our last podcast episode, in a deal worth about $40 billion US.
Yeah. So we already said how much we like this deal and how promising we think this is. This is actually the real kicker. And I think in the future, NVIDIA will really solidify itself in the semiconductor space. It's now the most valuable semiconductor company in the world. So yeah, I think NVIDIA ARM is actually probably my favorite merger that happened in the past year or something. Just because the possibilities for semiconductor and data center expansion that it gives them. I've done a full analysis on it on our blog, which we will link in the description below or in the annotations. So yeah, look out for that, read through it, and maybe give us feedback if you feel necessary.
I think with the NVIDIA ARM acquisition, NVIDIA can really solidify itself as a competitor with chip makers like AMD and Intel, which will obviously give them a boost.
Yep, Intel especially.
And we go more in depth on that in our previous podcast episode and on our upcoming blog. So make sure to check
I wanted
that
to add something. SoftBank, they actually, they sold it to NVIDIA via half of the money in share options. So now SoftBank actually owns a bigger part of NVIDIA than they did before, which is, I believe it's a over $20 billion stake. So that gives them more institutional investor backing as well. And on the news of this, NVIDIA shares, I think the same day they climbed up 8%, which actually covered all of the gap needed to buy the company itself. So that's actually really cool. But after that, NVIDIA obviously tanked because the rest of the market did. So all of those gains are erased now. But I guess that just makes it a better time to enter into the stock.
Yeah. Next, we have news that the Feds are willing to create as much fiscal policy as needed to boost the economy at the expense of higher inflation rates. Obviously, this could have drastic economic effects. What are your thoughts on this?
I mean,
Yeah, I think this will probably make more people run towards fixed income securities like bonds and stuff. But at the same time, it could lead to a more inflated market as well. So, there'll be like investors wanting to ride the bubble up, I guess. But I don't know. I feel like somehow, to some degree, the economy itself is kind of like disconnected with the markets.
Yeah,
right?
at this point, yeah.
So I'm not sure how this will connect because I feel like a lot of this has been like factored in, right? The inflation that they're not obviously factoring that in. And yeah, I think that's pretty much already in display considering like the S&P is higher than it was pre-COVID, despite the falling revenues and stuff.
I mean, it depends on how long the Fed is gonna like have inflation rates climbing like this, because as the famed economist John Maynard Keynes said, inflation can temporarily be used to boost an economy, which is probably what we're seeing right now.
And obviously, the flip side to that is overinflation, hyperinflation can really chip away the buying power and completely wreck the economy. So you really have to be careful with how much fiscal policy you introduce into the system.
As of the duration of this policy, I'm pretty sure it'll extend. I mean, JPOW is comfortable with extending it to, I think, 2021 or 2022, keeping interest rates low until the economy recovers. So I don't think we're going to see any kind of...
Yeah, I think he said interest rates will be at current levels until 2023.
2023, okay.
I believe, at least, right?
Yeah.
Yeah.
So quite a while in the scope of things.
Yep.
Yeah. Next we have the IPO of Snowflake. But now investors are skeptical of the company due to its heavy reliance on AWS.
Yeah, but let's just talk about that IPO price though, because they were gonna list at $85, and ultimately they ended up listing at 250 something crazy like that, right? So they ended up getting way more funding, and also Warren Buffett is involved with this, and a bunch of other big institutions. So that's why people were really confident initially. But since then, the stock did fall a bit, in retail trading hours because it was very overpriced.
Yeah, I agree with you. And the latest news we have, well, not really news because it'll happen in 2 days, which is Tesla's Battery Day. Where it's expected to announce new technologies like the 1 million mile battery. So what do you guys think about these new technologies, about Tesla as a company?
I mean, if this 1 million mile battery works as like planned, then obviously that's a big boost for Tesla as a company, right? Because more people will flock to electric cars more and more because they'll see that how much money they waste on gas, and yeah.
I mean, that's rational thinking, right? And you have to think about the fact that a lot of people don't behave in the most rational way. Even though they may have 1 million mile battery, people might still prefer gas cars due to the convenience. But I think the main thing from this 1 million mile battery is that Tesla can start selling their products to other electric car manufacturers. Since we do see more companies starting to venture into the space, seeing as Tesla is very profitable. And so Tesla could also make a profit out of this, selling their batteries to other companies, because they do have a lead and a boost on this technology.
Yep. Tesla Battery Day historically, I mean, has been a spectacular kind of event for the market. I mean, for Tesla stock.
I mean, it's lots of volatility though, like at times, right? If
Yeah,
expectations weren't met, it led to a lot of volatility.
Spectacular in the sense, it's very volatile. I guess options premiums always go up.
Mm-hmm.
But yeah, one company that it is also going to have an effect to some extent on this, I guess, is LAC, ticker LAC. I think Lithium
Americas, yeah. They'll be announcing some acquisitions as well.
Yeah.
But yeah, I think some of that's probably just rumor mill. Some of it might be actually happening.
It could be, yeah.
So I don't know. I'm excited to see if they make any exciting acquisitions. That'll help them like reduce their costs for lithium sourcing, or maybe they're making a totally different battery that's not even lithium based. We'll see.
Yep.
But yeah.
And before we move on to IPO and underwriting, which one of these recent developments do you think would be the most significant? Which of these do you think is the most important?
Well, okay, of permanence, I think the Fed policy, but personally, I think the NVIDIA acquisition of ARM, that probably really changes the semiconductor sphere. So I personally think NVIDIA.
Yeah,
Yeah.
I agree
Yep.
with the Ritvich.
TikTok, Oracle, Walmart, that's probably going to be, it's a very costly acquisition, but I don't know if it's going to have that much of an effect compared to NVIDIA ARM.
I feel like it's more of something on a political scale. It's
Yeah,
just
yeah.
political dealings through
I
business.
think any gains
Mhm.
made through the Oracle
But
TikTok deal have to be wiped off eventually. I don't think that it's realistic to see Oracle's share price rise on a silly acquisition like that. But if
Yeah.
And honestly, fiscal policy until 2021 to 2022 is pretty short term.
Mm.
Whereas with Nvidia, this ARM Holdings is going to boost its sales for like maybe a decade, because Nvidia up until this point has only been in GPU
I mean, it's not
space.
just sales,
and
right?
CPU
It's
space is
also
so
research.
vast.
They get a lot
Yeah.
of the ARM research, and that's going to be very important for new innovation to occur over at Nvidia. And if they can get like some sort of vertical integration type thing, with like networking with GPUs and with CPUs, that'd be super cool. I mean, it would be crazy to maybe see Nvidia producing like their own computers or something sometime soon, because they have everything they need to do it. So I could see it happening, but
Yep.
Kind of like a giant software. What do
Or
you call it?
hardware.
Mega
yeah, it'll
company.
be like
Hardware
IBM or
and
something.
software.
Yeah.
Yeah, pretty much.
All right. So
Okay.
let's move into
Let's move on to
yeah.
root
So
pitch.
let's move on to underwriting. So underwriting is just basically how a IPOs and underwriting. It's sort of a 2-in-1. But an IPO is basically how a company like goes public, right? And then underwriting is when companies issue securities to the public to help finance itself, right? So it could be the issuance of shares or corporate debt like bonds. Investment banks are generally the institutions that help people underwrite, because they know where the money is, right? Like they have connections to wealthy people, clients, that type of thing. And frequently these banks are able to engage in some of the risk that the company is taking, because the bank is the one issuing the shares, right? So for example, a bank may say to you that they will attempt to sell all of the shares to the market that the company is issuing at the best price possible, and then sell the rest back to the company. So this is known as a best efforts deal. Or the bank may choose to hold all of the shares all the way through, even if they don't sell all of them, and decide to only sell a limited amounts in hopes that the price will continue to increase, which is called a bought deal. Regardless, though, what a bank does when it underwrites is it tries to understand why a company needs financing, and it slaps its name on it so that they get some reputability, right? That's one thing. But also, there's a lot of processing that has to go through with this legally, and banks they make a profit usually off of the underwriting spread, which is what they call it, which is the difference between the price that the shares are purchased for and then resold for. So underwriters are generally allowed to manipulate the volume in shares in order to fix prices, and this is encouraged by the SEC to minimize volatility, because when the first time that the security comes out, it's usually a pretty volatile time for the market, because the expectations are all over the place. And then my question for this is that people always like to say, like, investment banks, they don't really do much. They're kind of useless in the role of the modern economy, because they're not making anything, right? Like Elon Musk has himself said that too many smart people work in finance and law. We need more people working in engineering. But do you think sometimes that people are like underestimating the importance of investment banks in the modern economy?
Definitely.
I think this
going back on
anti.
Elon Musk's quote, he said that a lot of people tend to go to finance rather than engineering. I think that's a totally different paradigm, because Elon Musk is a very product-focused person. He likes to look at new technology that could change the world, and that's a very good thing. It's good for the economy, it's good for production, good for manufacturing, and it's good for society
Right, banks
overall.
make it possible, right?
But in order for these companies to flourish at all, yes, we need banks.
I feel like,
And that's a different paradigm that I don't think Elon Musk completely understands. For companies like Tesla to even be created, we need banks to help with a lot of their different financial areas.
Yeah, of course, investment banks
think,
are the very backbone that drives the American economy. Like, you need to have a free market in order to have the American economy. It's the very essential component. And if you don't have a source for companies to at least go public and do their underwritings, then what is the economy,
Exactly.
I think this kind of anti-bank or anti-investment bank, or seeing investment banks as unimportant, is kind of fueled by the 2008 market crash.
Yep.
Still, because they were kind of the main people responsible. But then again, I don't really see it as rational to hold them like accountable for this long. I mean, they after all they are the
to a
backbone
sense,
of the American economy.
To
We
a sense,
couldn't-
I think the consumers may be to blame too, because they were taking on mortgages they couldn't afford, right? And sure, the banks.
But the only reason for that was
I mean, in a sense, I would
leniency
put that on the
of
banks,
investors.
because it's the
I mean,
banks'
of
fault
institutions.
that they should have made sure that their consumers are able to
Yeah.
pay off their loans. That's the main purpose of the bank, is to be the financial person in this scenario. That's why you have them doing the IPOs for these companies, because the companies don't specialize in finances. The companies specialize in whatever they're producing. The banks need to help them with their
Right.
finances.
Well, helping a company get funding is like one of the core principles of entrepreneurialism, and sort of helping help spurring innovation, investment. You need banks for that role. Like, I know they're sort of a middleman, but what they engineer, what they specialize in, it's nothing short of miraculous, because outside of it, it's super hard to see a massive growing economy like we do in the United States today. Compare the economy here to any second world country or third world country, and you'll see how much of a difference it is, right, in the process of how a company gets funding. It's so much easier to get funding here, and it's also easier to it's just
Definitely.
as easy to declare bankruptcy and go back into the world of being an entrepreneur, being a businessman. Whereas in another country, if you go bankrupt, you're sort of seen as an outcast, right? Because there's so few opportunities there that when you squander it, it looks terrible. Whereas here, there's new opportunities constantly arising. So it's like it's a constant cycle. And I feel like investment banks, they get a lot of flack, but you have to consider the Fed interest rate manipulation at the same time during the recession, and I think that probably had a big part to do with the recession as well. But yeah,
I think a lot of a big reason why nobody likes investment banks is because nothing they do is tangible. You can't really see or feel what they're doing.
Well, the consumer can.
You can see the company
consumer
products.
can't,
You can,
right?
yeah, the consumer can't. The consumer doesn't know what the banks are doing, but the consumers know the companies. They buy from the companies. They use the company's products, but the consumers themselves don't use the banks. The bank services, and so they don't know how useful the banks are to companies.
Yeah, exactly.
And I think that's one of the companies will know how useful investment banks are, but consumers won't know at all.
Right. And another pro of IPOs, it's that these public investors are able to sort of invest in any company that they want to, right? And I think it's basically the first time that a company goes from private to public, which means that anybody can invest in it through a broker. And IPOs are actually set at relatively low prices so as to drum up the excitement for them and attract higher investor volumes. So, like, on average, IPOs rise 16% on the first day from the initial price. So that's very interesting, and a lot of times people do see them as a profitable move, like for the short term. And that's why usually IPOs, they're not available to everyone in the first few hours, because people will just arbitrage them, right? Like, they'll just buy and sell and profit off the bid ask.
Yep.
So that's why it takes a while for us retail investors to get access. But a lot of times they're still undervalued when they come onto the market. So you can still take advantage of it. But Raghav, do you want to discuss a little bit more about IPOs?
Yeah. So their IPO stands for initial public offering. That's the process of issuing equity to investors in the form of shares. I assume you already know this, but usually they do this to either finance big future aspirations, acquisitions, maybe a new product that they're coming out with. Um, this is the process from which a company goes from a private company to a public company. So a private company does not disclose any of its financial information, uh, hence the name private company, to investors, and they do so as they please. The pro of that is that you won't have bad financial statistics to deter investors, but being a private company doesn't exactly give you that much, I guess you could say, availability to investors. The exact opposite is actually true with the public company. Early investors in a private company could include friends, founders, family, and angel investors. And when a company goes public, it opens up investment opportunities to investors like you and I. We can buy shares through brokerage services such as Charles Schwab, Robinhood, TD Ameritrade, and others. Uh, Usually, sometimes these brokers make sure high-profile people get access to IPOs earlier than us. as Ruthven just mentioned. Because if everyone got access, then we would just keep doing the buy sell strategy. So the requirements for an IPO is that the company, first of all, has to be one of the top players in its sector. Strong management or financial teams, has to have a lot of growth potential, and a consistent cash flow and revenue. The price of an IPO and how to get it into the market is advised by investment banks and investment bankers, which they get around 2% of the commission of the total equity, which has been IPO'd, to help with the process of going public. But the price is ultimately decided by the company. Usually, the price of the IPO is relatively low in order to attract more investors to the company, um, so that more people will buy equity, hence raise more money. Um, and then usually, when the company gets IPO'd, the financial committee of the company decides how much stake in the stock each executive gets. For example, Jeff Bezos actually has 16% stake in the Amazon stock. He got that when it IPO'd, and since then he's so rich because the stock has skyrocketed 3,800% since IPO, which really shows the power of a low
Mhm.
IPO.
Well, I mean, it's grown a lot since
So
then,
I
right? So
have
that contributes to the price increase,
yeah.
obviously. But also, yeah, we should mention
Yep.
that people can take companies back private as well, like Dell did. You can get bought out by a private equity firm and then decide that I want to do some restructuring without scrutiny of public investors, and buy the shares back from them, and then go back into public once you feel like you've done enough where you feel like you can require public funding again. So Dell
Yep.
did that because they felt like they were coming under too much scrutiny and they wanted to do some restructuring that would hurt their funding too much. So they decided to take it back public using a private equity firm, and I think it was Sequoia, and they came back public, after a few years, and after that, everyone was more excited about Dell again because they thought that they made some worthy improvements that they just took some time, right?
Yep. The same goes for certain types
So
of bankruptcies, right?
Mhm.
They can kind of declare this kind of restructuring state and restrict people from trading their stock in order to kind of sort things through within the company and then go back. I forget what the exact chapter it is, but yeah, that is a type of bankruptcy.
I have a few questions. Number one, what do you guys think was the most successful, or I should say, hot IPO of this
This
year?
year,
This year?
seems like
hmm
Snowflake right now. We'll see that.
I mean, recently, I would say Rocket Mortgage.
Yeah,
Rocket, yeah.
that's what I was
Rocket has
gonna
a
say.
really big stake in the mortgage area.
Yep.
And the house sales they haven't been down. Lumber prices have gone up. House prices have gone up recently. So I
Borrowing
think
is up.
Rocket Mortgage is gonna. Yeah, I think Rocket Mortgage is gonna be a pretty interesting IPO.
I mean, yeah, it's
Or
already
it
out, but
has
I
been
think
interesting IPO.
fundamentally it has a lot more room to grow, right? I think in a year or so we'll see a big price
Yeah.
increase.
Fundamentally, yeah.
And we already kind of talked about this, but how important do you guys view investment banks in the process of going
Hmm.
public? Like, do you think the company could just um, go public on its own without the help of an investment
Of
bank,
course not.
or do you guys view
Definitely.
them as
Yeah.
necessary?
So like I said when Rootwich asked, I would say that, like I said, investment banks exist so that the companies that are IPOing, they focus on what they're doing. So Tesla, let's say Tesla's IPOing, right? Just as an example, I know they already IPO'd, but whatever. So Tesla focuses on their batteries. They put all of their manpower, all of their brain power into making car batteries, into making cars. They don't worry about how we're going to do the IPO, how we're going to underwrite. They don't need to worry about any of that because the investment bank will do that for them. And so Tesla doesn't have to waste any of its own money on managing its IPO, its financials, any of that.
Yeah, well, I mean they do pay the investment
And
banks
so I
to
think
do it, but it's because they're so good at doing it is why they exist, right? They're great at getting funding for companies, so that's what their job is, and their role is pretty secure, I think. And they have a lot of smart people working for them, so yeah, I think they're very essential to the role of an IPO. But yeah, I think that does give a decent summary of how companies go public and how they issue debt and equity. How about we move on to the due diligence now for Factset. So I'll give like a quick introduction. If any of you have any relevant experience or are friends with people in investment banking / high finance, you know that Factset is the lifeblood of their financial analysis toolkit. When it's not Bloomberg, right? So and Bloomberg isn't even publicly traded, so we can't invest in it. But if we could, I would talk about it. Factset has been around since 1978, and it's considered a staple, just like Bloomberg, in many wealth management firms. And it offers some of the easiest to access and understandable financial data. And so many newer firms that are less focused on trading have switched to Factset because it has a lot of the same data that Bloomberg offers for like half the cost. So when it comes to modern financial data, Factset outcompetes Reuters and arguably Bloomberg as well due to their API services, and also it's like a lot more open source. So it makes Factset much more preferable to people who are in quantitative divisions of banks, like hedge funds. That have like API integration with Python or R, and they have a management system which allows you to run algorithms on it. So that's really cool. Bloomberg does too, but Factset is much more accessible, right? So it's better for people who are like traveling per se, and also it like costs way less, right? So we'll compare it more with Bloomberg later, but we'll focus more on Factset as a company itself. On their website, they state that their mission is to integrate the data that you need with your applications, web portals, and statistical packages, whether you need market, company, or alternative data. So and Factset's flexible data delivery services give you normalized data through APIs and direct delivery of local copies of standard data feeds. Our unique symbology links and aggregates a variety of content sources to ensure consistency, transparency, and data integrity across your business. Build financial models and power customized applications with Factset APIs in our developer portal, right? So that's quite a mouthful, but we'll dive into the service itself. And Mahesh and Harish have their own, sort of individual divisions that they looked into for it. But Factset is this like very key provider of buy-side portfolio analysis for investment banks, hedge funds, private equity firms, etc. And it's making its way into non-quantitative hedge funds as well because, quantitative portfolio management, it makes the automation of risk management and the application of portfolio theory a lot easier. And Factset automates that for you. So, like even traditional hedge funds should use them, right? Factset also provides more than just solutions for financial companies, and Harish will discuss their, corporate help with M&A strategy, corporate development, treasury, FP&A, investor relations, that type of thing. But I'll discuss their financials, just so that you have an idea of how stable and investment worthy the company is. So here's what the last 8K filing reported. The revenue increased 2.6%, or $9.6 million, to $374 million, compared with $364 million for the same period in the fiscal year of 2019. This increase is primarily due to higher sales of analytics, content and technology solutions, and wealth management solutions. Annual subscriber value plus professional services was $1.52 billion at May 31st, 2020, compared with $1.45 billion in May 31st, 2019. And this is really good considering, the COVID crisis, which slowed down a lot of growth for even tech companies like Microsoft, Apple, etc. Factset was able to continue to keep growing because data was more in demand at this time, right? So this organic growth rate, which excludes the effects of acquisitions, dispositions, and foreign currency movements, was 5%. That's a 5% growth in annual subscription value. And that's actually one of the most important metrics for software as a service company or product as a service company. And a lot of the workflow solutions, the increase for them was attributed to a price increase for international companies that use Factset. That's another thing I wanted to mention because Factset is so much cheaper, a lot of developing country companies can use them without bankrupting themselves and paying way more to Bloomberg. So the adjusted operating margin was improved to 35.5% compared with 34% in the prior year period, as a result of reduced employee-related operating expenses due to the coronavirus pandemic. So imagine it this way. This is such a recession-resistant company that they were able to increase operating margins instead of decrease them because they had to spend less on offices, that type of thing. Diluted EPS increased 11%. So earnings per share increased 11% to $2.63 compared with $2.37 for the same period in fiscal 2019. The company's effective tax rate for the third quarter decreased to 15% compared with 18.6% a year ago, primarily due to an income tax expense reduction. And so that's another positive, right? Factset increased its quarterly dividend by 5 cents per share, or 7%, to 77 cents, making this the 15th consecutive year that the company has increased dividends. So yeah, look at that. Only clear financial picture. We've seen that the free cash flow has consistently increased ever since its conception, and the annual subscription value is growing mostly in Europe and Asia Pacific now. So that's where the market is.
So the primary service that Factset provides in terms of data is their data marketplace. So that's a place where users can go to get several streams of different financial data points that are provided both by Factset and by the third-party data providers, which is data that's already been cleaned, already been processed, that you don't need to necessarily go and scrape somewhere else for. And so you can pretty much integrate that data with your existing infrastructure or leverage Factset's cloud hosting platform for databases to interact with that data. And so they provide this all-in-one platform for you to download and upload data, as well as use that data for researching financials with the tools that they provide. For example, data scientists and software programmers can use their data exploration platform to use technologies like Python, R, SQL, TableU, and others, along with data visualization software in an already, again, cloud-hosted environment, which manages the database for you, so you don't really have to take care of hosting it all. One thing that's pretty interesting about Factset is that they have partnered with Quantopian, a popular and I guess well-known company in the quantitative finance space that allows quantitative analysts and quants to quickly backtest and prototype different algorithms. And so when you couple that kind of existing software platform that Quantopian has with the extensive data that Factset has, you have this perfect combination where you have essentially the entire streamline of what you need to do in a quant scenario, right? You need to get data, which Factset provides, and then you need to do the analysis with Quantopian. So that's pretty interesting. Another thing that's pretty interesting is their partnership with Snowflake. So like we mentioned earlier in this episode when Snowflake was IPOing, Snowflake allows you to, I guess, host your, in the context of Factset, allows you to host your databases using either GCP, AWS, or Azure. And so it allows for large and complex queries to be run without you needing to use your own infrastructure, only needing Snowflake. So this simplifies the data pipeline of taking external data and combining it with your own and serving that on a database. One other interesting thing, this is the last one, is that for machine learning researchers particularly, their partnership with DataRobot allows you to test, build, and deploy different types of machine learning algorithms in the realm of finance. So that includes both just microeconomic prediction or anything on a stock, as well as just macroeconomic kind of factors. And you're allowed to do that with ease thanks to this partnership, I guess. So that's the main three, I guess, partnerships that they have and services that they provide for data scientists.
All right, and Harish, you want to talk about the corporate development side for Factset?
So Factset also allows corporations to find merger and acquisition targets through their software. It lets them access real-time news and intelligence, and it gets them the latest financial information on companies and markets all over the world with one of their services. It helps them find company risk relations and classifications, as for what actually companies do, what they delegate their manpower and brainpower to doing. Also analyzes private company data, so not just public companies, but also helps with 40 private company data items, including rounds or securities invested, management and board members' financial data, and employee counts.
Yeah. So, and on top of that, there's they provide insurance risk assessment. And then for the companies, it's very useful for analyzing your competitors, right? So if you want to go and see your competitors' finances, look at private company finances, which usually they don't give out access to. That's where you would go to. You'd go to Factset, right? And if let's say you want to eat up another company, let's say you're Nvidia and you want ARM, it's a private company, perfect situation where you would be using Factset, right? Because you want to look at their data, you want to look at who their leadership is. And yeah, usually, it's better for a smaller company usually, right? Not for Nvidia acquiring ARM, because they could just get that info from SoftBank. But let's say you were in a similar situation, it was just smaller companies where, the ease of data wasn't as available, then you would use Factset. And if you want to analyze your own corporation's risk, so all that sort of stuff, Factset corporate development would be useful for. Bloomberg doesn't provide any service like that as far as I'm aware of. So yeah, that's another space where Factset is venturing out into more than just fintech. They're going into insurance and corporate development as well, right? So and here's what Factset said this is what Factset said in their last 10K about talking about their competitive position within the market and providing financial data. Despite competing products and services, we enjoy high barriers to entry and believe it would be difficult for another vendor to quickly replicate the extensive databases we currently offer. Through our in-depth client and analytics service, we believe that we can offer clients a more comprehensive solution with one of the most broadest sets of functionalities through a desktop or a mobile user interface, or through a standardized or bespoke data feed. And Factset is confident that their ML services cannot be replaced by anybody else in the industry. In addition, our applications include our client support and service offerings, and are entrenched in the workflow of many financial professionals, given the downloading functions of our portfolio analysis/screening capabilities offered. We are entrusted with significant amounts of our clients' own proprietary data, including portfolio holdings. As a result, our products have become central to our clients' investment analysis and decision making, right? So this just tells you that they've created a big network economy, right? So with more people that they add, like their revenue will grow exponentially because they're able to interconnect more and more companies' data together, analyze it faster, and with each customer they get more than just someone who's paying them. They get a piece of data, right? So all of that data is for them to use and for them to train their machine learning models off of, for them to be able to inform other companies and create like it, and for news to access the data, that type of thing. So I believe the Motley Fool, they also use Factset, right? Because they have a lot of data, right? So yeah, and it's because of that network economy, that term. And if you read the full report and compare it to the most recent 8K, if you compare last year's annual report to this year's 8K, you'll find that the real expenses this quarter were far lower than expected in the last 10K, as there was a lower than expected tax rate and a 3% increase in expected operating margins from the expected figure as well. So the company also reports a 90% customer retention rate over 15 years. So that they're not lying when they say the clients need them for all sorts of financial services, whether it's for M&A or wealth management and equity analysis. Let's talk about the financials of the company itself more in depth. Factset has had a decreasing cash conversion cycle because they've been a subscription platform. They still have a very low cash conversion rate. So right now it's at less than 40 days to finance, which just means that they have less days where they need to borrow money, right? So and FDS had taken on a lot of leverage in 2015, but since then they've been able to reduce the debt to EBITDA ratio significantly. So what's up with that? Why were Factset's long-term debts like at zero all of a sudden, and why they spike up? Well, usually for a company that's non-cyclical and has a well-established product like Factset, leverage can actually be good at amplifying returns. So I wouldn't be scared of the debt because that's actually going to be increasing their returns now. And you can see that since they've taken on the debt, they saw some volatility from early on, but the stock actually continued to grow since 2015, right? So this was actually able to help the share price if you go and look at the chart right now. And you can see that debt over EBITDA is beginning to start a rapid decline because the EBITDA has increased since then. And this only adds to my theory that Factset is trying to expand into new playing fields, right? Or why else would they take on leverage? Factset obviously didn't need the leverage to cover their normal costs because they've always had consistently growing margins and revenue. So the debt financing was only for the sake of financing growth. And this debt can be considered covered and paid off, considering that the net income growth of 32% between 2018 and 19 and EPS growth of 33%. I'm pretty sure the debt interest rate is going to be like 2%. So I'm not concerned about them being unable to cover the debt. EBITDA has been virtually exponential for Factset for a while because of the bang for buck for their well-known product, but also now as Factset ventures into algorithmic trading and corporate development, the scope for the growth is broadly expanded. The price to earnings ratio right now is sub 30, and that's lower than it was last year, and it makes it a great time to buy. So for the past 2 years, PE has been declining. Return on equity has increased for the past 2 years, and cash per share has increased significantly for the past 2 years. And yeah, mountains of cash have been piling up into the coffers, which just increases the chances of offering increased dividends for shareholders. And on top of that, there's a lot of buybacks that are going to be coming soon. So yeah, a large buyback expansion program was implemented for $210 million worth of shares, which shows how confident they are in the company itself. SG&A expenses per gross profit has been declining despite the expansion of international offices. And the only reason I'd be concerned about this company now is because of the skin in the game that the leadership has. So very few executives/board members have significant holdings in the company. So that always does concern me a bit, but considering how old Factset is, that does make sense, right? Usually only a new CEO has a lot of stake in the company. And the CEO himself is a veteran at Factset. He knows his way around the company. And so although Bloomberg beats out Factset for trading and fixed income securities, and Reuters does beat out Factset for being a legacy company, Factset is the growth stock here. And they have the biggest chances for increasing cash flow and taking market share from their competitors. Factset has a lot of growth left in its industry, which is already fast growing in and of itself, which is, fintech and financial research. And it has a lot more potential at its current pretty low valuation. So earnings for Factset are September 24th, and I think it should be a pretty big beat because investment banking trading demand has gone up, and there's been a lot of M&A activity as we already discussed, which if you're listening to the news portion, you know that Factset is needed for that, and investment banks do like using Factset. So and I think that just creates a good buying opportunity pre-earnings, but also it's a great long-term investment. What do you guys think about Factset?
Yeah, I mean, I definitely think the demand for fintech is going to see a rise soon as we see more integration of finance and tech technology like software and machine learning. So yeah, I think definitely a company to watch.
And just seeing how good their margins are and how low the valuation is only makes it look better, right? What about you, Harish? What do you think about Factset?
Yeah, I think it'll take some time for people to realize the true valuation of Factset, especially since it's not a very well-known company. I mean, I would say among like the typical investor, but probably again among like institutional investors who see this company as undervalued. But the regular investor probably doesn't even know about this company. I think that's why it's mostly undervalued right now.
And Factset, obviously it has other great metrics like 21% return on assets, 52% return on equity, which is way far outperforming any other competitors, and 29.3% return on invested capital. So for me, I think it looks like a clear buy. It is at like a somewhat high valuation using certain metrics, but considering like how high the tech valuations are, this actually isn't that bad. So yeah, the profitability of this company is obviously great. All of the margins are great. Operating 31%, net margin is 25%. So yeah, I mean, they don't need to spend money on a lot of stuff, which makes them, a really good standout in the tech industry because they're not over leveraged or anything considering how much money they have. And yeah, the valuation, it looks mid compared to other companies, but compared to other tech companies, it's actually a bargain. All right. And thank you everyone for listening to this episode. And yeah, please leave any suggestions that you have. Harish, do you need to give our outro?
Thank you for tuning into the 7th episode of The Dogs of the Law Street, our economics and finance podcast. Make sure to check in on our blog with the link in the description to get a much more in-depth analysis on Factset and many other more editorials coming in the future.